Good afternoon, traders, and welcome to another Profiteer Trading video. Today we're going to run down what happened yesterday early morning during the Fed announcement. Take a second to read the risk disclaimer. Trading futures and options on futures involves substantial risk of loss and is not suitable for all investors. Opinions, market data, and recommendations are subject to change without notice. Past performance is not indicative of future results. Take a second to let that sink in. Okay, let's move on. All right, so on yesterday, we had a huge bit of news come out at about 8:31 Eastern. So coincidentally, right when jobless claims came out, which was obviously enormous once again. And essentially, the Fed said, look, we're going to provide more liquidity, so more loans, through the Paycheck Protection Plan to small businesses, and of course to any companies that are considered fallen angels. So companies like Ford, companies like Boeing, basically before any downgrading happened by Fitch or Moody's credit rating, they were treated as if they had never been downgraded, so they can still receive backing. The rest is just a lot of financial jargon, but that's really all you need to understand is that the Fed came out and said we are going to provide credit liquidity to those that have been downgraded, and we're going to basically ignore or act as if you have not been downgraded through the term asset-backed securities loan facility. So $850 billion in credit backed by 800 and what's that? $85 billion in credit protection provided by the Treasury, and this will help state and local governments manage cash flow stresses caused by the coronavirus by establishing a municipal liquidity facility that will offer $500 billion in lending and to states and municipalities. So that's huge news, especially because they're broadening the range of assets that are eligible as collateral. So broadening the range of assets, like think about what that means. They're basically saying we will take a lot more debt than what we would usually take given the circumstances of the coronavirus. Commercial mortgage-backed securities, newly issued collateralized loan obligations, CLOs. So I encourage you guys to look up what those are. We're not going to get into that now, but at the end of the day, it's basically including student loans, auto loans, credit card loans, and basically anything that could possibly go into default. So at this point, the Fed is straight up creating a backstop against the whole economy. So this goes very much in line with the Japanification that I've mentioned before. So in the late 80s, during the boom of the Japan Nikkei market, this is exactly what Japan did. They basically started to create asset-backed security loans on pretty much anything up to stocks. So it's unclear yet if the Fed is willing to buy stocks, but at this point it seems as if they're about to. But that's an opinion, doesn't matter. I want to just touch on the weekly trading stream real quick and bring you guys back to the beginning of the week real quickly and just point out here that we had the narrative in place basically saying that if anything were to occur from unscheduled risk this week, it would be global stimulus, fiscal, monetary, the phase 4 infrastructure being discussed through the fiscal side, and basically anything that would lead the Fed to catch the falling knife, if you will, being created by jobless claims. And it's not so much of a falling knife. I guess it's more of an exponential growth in jobless claims. So right here, you can see on the 7th, we basically said that phase 4 stimulus discussions rumors are pushing risk appetite. So Congress to push for the next deal while Fed opens the special small, medium-sized enterprise loan facility, as well as the paper market facility lending, which is all of the facilities that they're using in order to inject liquidity specifically into certain areas of loans. And what I said was we need to watch for comments, and the FOMC this week could reveal some changes. Unemployment increases seem inevitable at this point, with initial jobless claims coming in 2 days post-Fed. We might see preemptive cushioning. Okay, so it wasn't so much preemptive. It was kind of like at the moment, in the moment. Keep in mind, jobless claims came in 2 days later. And that is why we chose to set up the Ultrabond, because it is basically a treasury. It is a treasury. It's the longest end of the curve. And what that tells you, when the Fed are speaking, it tells you how the market really feels about the situation. So we had a setup here, technical setup on the TPOs, watching the 30-year yield. You can see there, US 30-year. That's the purple or pink line. And then there is the UB futures, which is the Ultrabond long end future, representing the long end bond. So I wanted to show you guys how the market reacted. The Ultrabond market reacted at 8:30 Eastern to this bit of news. So let me just find 7:30 Chicago time. Okay, so there it is. All right, so now you can see a couple of things. You can see the actual amount of contracts that traded within this area at the moment of the announcement. Here you can see the electronic trading hours session. So right here is where we have the open of Asian trade. So you get an opening drive that dips into a low of 2020, 220 there. And then through the overnight session, we get a bid into composite value area, which is here. We find the 2022-15 level, which we mentioned in our hypos. And then we find some compression into the morning session just before the announcement. Here is the pit session open. So the fixed income market opens at 8:20 in the morning, so about 10 minutes before the initial announcement. So you can see that the first thing that occurred was the initial move out of the Fed. Now, when the Fed moves, the bonds move, and that's why we chose to trade the Ultrabond. So I'm going to show you now how that played out to give you an understanding of how we can read this to extrapolate on the ladder. Let me pull this up a little bit. You can see that. All right. So currently we're trading 2022.30. It's about 8:27 a.m. Eastern. And keep in mind that we are approaching the 2303 level, which can be found in the same spot that you had sort of a compression at the composite value area from the previous day, just above. And we talk about initial balance range in the room a lot, and I just want to point out that the initial balance range low from the session is shown here with the red line, and you can see that if I back it up a little bit. There's your initial balance range where the blue line meets the red line, and that is basically the 5 to 30 minute low of the opening range session from the electronic trade yesterday. So the fact that we couldn't get back above that section as you see here, for the electronic trading session that happened on the 9th, you knew that there was some technical significance to this, what I guess you would call a bear zone. So we want to watch sort of the quiet nature of the Ultrabond order flow to sort of acknowledge that the amount of trade going on here is trying to tell us something. So notice on the depth at 08s, you've got 38 looking to offer, 26 looking to offer at the 05s. And although you've got a decent 50 or so trying to bid into this level, you can see that they are continuously getting absorbed by the selling that's coming in on the tape here. So you get an attempt at buying, but notice here you've got 13 that go offer, 18 that go offer at 23 evens. So you know that this sort of behavior at this key level is trying to tell you what is actually happening during this trading moment. And you can see on the footprint here that as we come into 23s, we still have 106 that print as an offer here. Can't get back above 01s here. You see 28 trade here, really kind of absorbing. Give me a second, guys. I'm just going to pause it for a second and restart it. This is a replay, by the way, obviously. So notice how we could not get back above these 23s. That's the level you want to watch. Notice the offers coming in are getting much thicker. Meanwhile, you've only got 3 on the bid and more like 18.8 on the offer. It's having quite a bit of trouble now that the Fed has come out. And you can see the tape is starting to move significantly. You have 20 that just went offer. A couple of 1 lots trying to come in. 110 lot that gets printed. But again, just complete absorption from all these offers that are coming in. And you can see them printing on the inside ask. And notice that as soon as we come back, we get absorbed. Now at 22.15s. And if you look at the previous analysis from that day, the hypo, you'll see that we said 22.15s was the level to watch to retain bull zone. So we leave that line in the sand. And the thing to kind of understanding on the ladder is that you can see the amount of depth here is fluctuating, but it remains significantly smaller than the amount of depth that you see coming into these 15s, where you can see, okay, we just had about 20 or so looking to offer there. They moved their offer up a bit. They brought it back down. Now they've got 50 there. And then there you can see the absorption come in strong. 11, 11, 11, 25, 30 is much larger than 6, 4, 18, 16. And yes, you're trying to read this as fast as possible in an environment like this, but that's why you want to try and practice looking at events like this to fully understand how things played out and why. So at this point, jobless claims has already hit and the Fed news has already hit. It's 8:32 Eastern, 38 seconds in. You can see that the market's pricing in the reaction to the amount of liquidity that is being injected. Notice how the depth on the offer continues to absorb the amount of bids. Even though there's some bid coming in, you can see that pretty much from the level that we trade at, the spread is about 3 ticks. 6 ticks away always remains heavier on the offer. And you can see that occurring here. So notice 24 trade, tick down. and the replay's having a little bit of a lag there, so we're actually trading down here. And sorry guys, I'll have to stop it again and restart it. Okay, so now you can see we're ticking in between 22 even now. And remember, we were up at 23.03. That was the initial move lower. It's about 8:33 Eastern. The market's already priced in what Powell has said. So we're trading pretty much at the bottom of the move down. And you can see that we're slowing down a bit, showing less of conviction to continue down at the moment until you kind of get this little snap up, and then you start to see these offers filling out. And sorry guys, my system is giving me problems here. But the whole point of this is just to make you understand how news can affect a market outside of your typical S&Ps and whatever else you might trade. And this can help you sometimes look to a different place to extrapolate liquidity. And that's why we chose the Ultrabond. And we'll probably be trading this more often, as I found it to be quite respective to order flow. It respects order flow well. And that's the type of market that I like to trade. So now that we're at these 21.28s, you can see that people are trying to catch a bid here. You can see about 25 traded against these 28s. That's why you see it halt there. And this is kind of where you get this compression. And it's about 7:35. So we haven't quite seen the low yet. And obviously in hindsight, it's easy to see. But you can really kind of tell why this happened from these large bids that are accumulating. Notice how they're always like a large double digit, like 50s and 40s and 20s, versus these that keep remaining underneath like 30, with the exception of a couple anomalies. And that's why you get that absorption, because there's just too much offer coming in to the bid that offers can't really control the downside continuation until you get capitulation, where they basically give up and step out of the way. So it's not necessarily that the offers just keep coming in when you get those ticks down. It's rather that buyers are they're giving up, which creates lack of liquidity to buy it. So you got to buy it lower because that's where they're waiting to buy it. You can see 19, 30, 34 traded there. Really only 7, 5, 6 traded here. The depth is starting to get bigger on the bid. That's why it goes snap up. You get a large attempt to kind of bring it back to those 22 evens. And continuous offers coming in, willing to offer lower. Bids thin out, offers thicken, tick down. Little halt here. You got 26 coming in against these 11s. Snap back up. 50s hit again. 13 trade down. There's your 24s. So just a nice slow accumulation to the downside. And you can see the pressure developing here on the cumulative delta. You can see 100 are pressing against about 76, 10 against 5 on the near term. You get this snap up, large bids come in again, and then continuous offers looking to absorb it. There's your 6, 5, 7. So you're basically seeing the auction in play here, looking to get below these 23, 24s. And at this point, the change in behavior does signify that this move could be over. Because even in hindsight, knowing that we're going to get a tick down to 14s, you can still very clearly tell that there is a bidding that is accumulating that's starting to balance out the downside. going to speed it up a little bit. So now you can see that buyers, as they start to halt the offers have to start making decisions here. And you can see that a couple of them are getting out. And then there you get a strong attempt to offer it again. And offers are just not getting anything. So one thing to note here is that you get these 23s that are willing to push higher, meaning they have to offer higher, and the bids are once again willing to bid into those offers. So now you know that there's a change in behavior, and you look to change your sides. Apologize, my replay is having some technical difficulties here. But yeah, guys, I think that basically sums it up. That once you see accumulation on the depth of market, and you see a lack of willingness on the opposing side, during a news event, you can use the tape, your initial balance range, technical range here on your time price opportunity to better understand what is likely to ensue here. Also, knowing a little bit about why the Fed moves markets, especially the Treasury market, can help you understand this situation a little better. So that's pretty much it. Just wanted to kind of share that with you guys. Hope you guys have a good Easter weekend, and we'll catch you all on Monday.